أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. So what we have in store for today, the plan when I did the syllabus, following the syllabus that was done for last year's class, we had to do the chapter 10, which leaves out completely chapter 11, which is the stockholders' equity. So instead of going too much deep into chapter 10 and leaving chapter 11 out, I decided to take a part of chapter 10 to give you some idea about the liability section, and then some idea of the stockholders' equity section, so that you have an idea about both, instead of having deeper knowledge about one and completely not discussing the other. So we will do a little bit from chapter 10, a little bit from chapter 11. The total content is not going to increase, it will still be the same. Okay, so let's do chapter 10 first, a few things that I would like to address, and you will see some overlap because we have discussed individual accounts from the liability and stockholders equity section. So you'll find some of this information you already studied before, you know from previous chapters. So for example, the first thing we're going to address is, what is a current liability? You know this already. The current liability is an obligation that the company has to fulfill, and it is reported in the current liability section if the obligation is going to be fulfilled within 1 year of the balance sheet date, right? Within 1 year of the balance sheet date. So this is the current liability. It's 1 year or operating cycle, whichever is longer. So for most company, the year is the operating cycle. Okay, they're the same. Then we have the second item under the current liabilities is the notes payable. Now, notes payable, you have a promissory note, you have borrowed, the company has borrowed money from somewhere and it will pay it back. If that is going to be paid within 1 year, it will be reported in the current liabilities section, right? So for example, we have an example here. That is, First National Bank agrees to lend $100,000 on September 1st, 2014. If Cole-William Company signs a $100,000 4-month note maturing on January 1st. So this is a 4-month note, right? This is going to be payable, and you can see this is a little bit because of the blackboard, the 100,000 of the notes payable, which should be on the credit side, it's on the second line, but on your printout it should be on the credit side. So debit cash coming in 100,000, notes payable 100,000. This is reported in the current liabilities because it's only a 4-month note, right? It's only a 4-month note payable. This is reported in the current liabilities section. You're following, yes? So at maturity, when it matures, the entry would be to debit notes payable and credit cash. Simple, right? Just a payment of cash. Cash will be credited 100,000. Notes payable will be debited 100,000. Are you following? This current liability, if the note payable is payable within 1 year, less than 1 year. Other examples of current liabilities, which is very common in many countries, is sales tax. And even in some GCC countries, they have sales tax, which is value-added tax, right? I think I sent you a survey that came to me about the value-added tax, right? The value-added tax, which is the sales tax, which is whenever you buy something, there is a tax on that, right? We don't have that in Qatar, alhamdulillah, but there is talk on collecting that tax. So anything you buy, there will be a tax on that. This is the sales tax. And this sales tax is very common in the US because this is a US textbook. So the examples are somewhat from the US. So what happens, the company that is selling the goods collects the tax from the customer. The company that sells is an agent who collects the tax from the customer and then pays it to the government, right? So the company that is selling the goods does not have to pay any tax, any value-added tax. The value-added tax or the sales tax, right, is collected from the buyer, the customer. The company that is selling collects it from the customer and then it pays it to the government at the end of the month, right? Usually, not usually, in every situation in the US, the sales tax is paid to the state. It is not a government, federal government, it's not a federal government tax. So every state has its own sales tax rate, sales tax forms, sales tax regulations, and so forth, right? Every state has, and we had, when I used to work in the US, we used to file sales tax returns every month for our clients that were located in more than 45 different states. So we had to deal with more than 45 different sales tax forms every month. They are simple, but they are a little bit different, right, in format and in reporting. So it could require expertise. If you don't do it on time, you could end up paying hefty fines. One time, one of my clients, I think he was in Ohio, what happened, he was late in paying the sales tax. So he did not pay the sales tax on time, and he had in his bank account $35,000. The government put a hold, they took $32,000 or $33,000 from the bank account because he did not pay the sales tax. So he called me and he was very worried because he needed to operate his business, he needed the money. So I immediately called the sales tax office, and he was on the phone with me. He was on a three-way line. The client was with me on the phone. I called and I asked the agent that, you drafted my client's account $32,000. If you go back and if you look at the history of his sales tax payments, it is about $1,200, approximately $1,200. He pays $1,200 in sales tax every month that he collects from his customers. So I said, what is going on here? He was late one time. If you want to draft something that is usual, why did you draft $32,000? The man told me that because we drafted $32,000, you're on the phone with me right now. We will give you the money back. Tell your client to file the form, send us the form, and we will keep the amount on the form and we will return the rest of the money. You follow what I'm saying, right? This is very, very odd. So I told the client that we gave you the tax return, just send it to the man, and he returned. So you see how seriously they take the sales tax, right? So here's an illustration, an example. The March 25th cash register reading for this grocery shows sales of 10,000 and sales tax of 600,000. Journal entry would be, you see, the debit is for the whole amount, 10,600, because the company is getting that money. 10,000 is sales revenue and 600 is reported as sales tax payable. So in your printout, you should have credit to sales tax payable. So when the cash comes in, right, it is debited, and the sales tax is already recorded as a payable because this money does not belong to the company, it belongs to the government. When they pay, what would be the entry? When they make the payment of the sales tax, what would be the entry? Okay. Sales tax payable debit for 600, cash credit for 600, right? Simple, you understand, right? So they're collecting the money on behalf of the government, and then it's a payable, recorded as a payable to the government, and then when they pay, payable is reduced. You following? Then we have another current liability, which you already know, that is unearned revenue. So if the company gets money before it provides the service or it provides the goods, you debit cash and you credit unearned revenue. Unearned revenue is usually a current liability. It's usually a current liability. Now, let's say you have purchased a ticket and the airline opens the ticket for you for 2 years because of this situation. Let's say, hypothetically, they open this for you for 2 years, right? This is money that they have received from you. It's unearned revenue. But they don't have to provide you with the service within 1 year. You can choose to defer the service, for example, more than 1 year, right? In this case, where should the unearned revenue be? Current liabilities or long-term liability? This is a very, very unique situation, right? You can argue both ways because the customer has the option of exercising the ticket anytime. So it could be a current liability. It could be, right? But reasonably, nobody is exercising. So reasonably, I mean, if you reason, you could say that nobody's planes are flying empty. So we don't think it is going to be a current liability. We have to serve the customer. So again, this is a unique situation. This just came to my mind. There is no definite, you could argue either way, right? So you see, many of these accounting rules are not like math. It's not black and white. You can argue. That's why there is auditing of the financial statements, and there is a lot of debate between the auditor and the accountants of the company to report certain things in a certain way, right? Because the accounting rules are open for interpretation, many of them, right? So just so you keep that in mind. So if we have an illustration for this, Superior University sells 10,000 season football tickets for $50 each for its 5 game home schedules. The entry the sales is going to be as follows. Cash is going to be 500,000 and unearned ticket revenue credit 500,000. And after each game, so if each one of these games is 100,000, after each game, unearned revenue would be earned, right? So you would debit 100,000 and you would credit ticket revenue, right? This is, you have already made these entries before, so this is old news for you. You know how to do all of this, right? Okay. Then we have something called current maturity of long-term debt. Current maturity of long-term debt. What is current maturity of long-term debt? The portion that is due within 1 year. So let's say you have a long-term debt, and that is, in this case, in this example, $25,000. $25,000 is payable for a period that is longer than 1 year. But a portion of that 25,000 is payable this year. Okay? Every long-term debt has a current maturity, which is payable within 1 year. Because if you have a 5-year loan, you pay something this year. Part of that will be paid this year, then next year, the next year. You're paying it in 5 years. So there is a portion always payable in the current year. That portion is called the current maturity of long-term debt, and it is reported in the current liability section. So if a $25,000 loan payable within 5 years, first year you have to pay 5,000. That 5,000 should be reported in the current liability, and in the other 20,000 would be reported in the long-term liability. Are you following? Not the first payment, whatever is payable in the first year. Because you may be making monthly, not monthly payment, you may be making monthly payments, right? But whatever you have to pay within 12 months, it should be reported as current liability. And whatever you're going to pay after the first year is going to be in long-term liability. Usually, the principal amount that is paid back is not the same every year.
Okay? It's not the same every year because the payment amount is the same every year. Payment amount, let's say you're making $1,000 payment every month. Payment amount is the same. The breakdown in that payment of the principal and the interest is not the same because the interest is calculated on the remaining balance, which reduces every month, right? So, make things simple. Whatever the principal amount is that you're going to pay back within 12 months of the balance sheet date should be reported in the current liability. Everything else is long-term liability, right? 12 months from the balance sheet date. Technically, if you prepare monthly financial statements like we used to do, like the one you have, this current maturity of long-term debt should be adjusted every month, technically. Technically, it should be adjusted every month, okay? If you provide monthly financial statements, but usually it is not. We did not used to adjust it every month. We used to adjust it once at the end of the year. So we'd see the next year from December 31st to the next December 31st, how much principal is going to be paid. That would be reported in the current liability. The rest is going to be in the long-term liability. Do you have a question? I mentioned about what? Unearned revenue, yes.
You mentioned that if it is more than 1 year, so you have in the long term.
I just gave you an example. Unearned revenue is seldom more than 1 year. Seldom. Almost does not happen. Follow? Almost does not happen. In rare cases. Right? In that case, if you're certain that it will be exercised after 1 year, then it has to be in long term. But if you're not certain, the customer can exercise anytime. The customer has more than 1 year, but the customer can exercise anytime, like the airline ticket. The customer, let's say, has 2 years to use it, and the customer can use it in any month now. In that case, you can argue. A definitive situation could be, for example, let's say you have a wedding hall that is booked, and it is so popular that it is booked 1 year, more than 1 year in advance, let's say, right? So if you want to have a wedding in December of 2022 or January of 2023, you have to book it now. Follow? In this case, the revenue would be earned at the time, right? Same is the case in some cases. For example, in some countries, if you want to go to Hajj, you have to book, right? For 2022 Hajj, you have to book from now. So the agency takes the money, but they will not give you the service until 1 year later. In this case, definitely this is unearned revenue. That is long-term debt.
If you pay the school fees to get an advance.
Who does that? Yes, of course. If you did, then definitely it would be unearned revenue for them. No, if it is the portion that is, again, anything that is within 1 year would be current. Anything that will be earned more than 1 year later, that is going to be long term, right? The current maturity is not related to unearned revenue. Current maturity is related to long-term notes payable. Yeah. Okay, is that clear? Okay, now we have something a little bit more technical, and I'm going to go through this, although this is not applicable per se to GCC or many other countries surrounding us, but it is applicable in many other countries, and you might have to deal with it. So just a little exposure. Payroll taxes, you have pay salaries and wages. Salaries are usually for upper level positions like managerial, administrative, sales personnel, etc., that are paid monthly, that are fixed. The salaries are fixed. Now, in Qatar, most people's payments are fixed, even if it is not a high-level job, right? They're getting paid a fixed amount. But in countries like US and maybe some European countries, you have hourly rate, they're called wages, and there is a minimum wage. There's a minimum wage that you have to pay if someone works for you 1 hour, right? There is a minimum wage, and it is decided by the federal government. It's also decided by the state government as well, so based on the living expenses. So you cannot pay somebody below that, no matter what they do for you. There is a minimum, okay? There's a minimum amount you have to pay. So you have three things going on here. One is the employee who's getting paid, let's say $10 an hour. That $10 per hour is going to be their gross earnings. Gross earnings, that is the entire amount that the company is going to pay them for 1 hour of work. But the employee is not going to get that entire $10 because the government will tax the employee. So what happens, the employer, let's say the tax is $2 for every $10, as an example. The company that pays the employee will give the employee $8 and keep the $2, which the company will send to the government on behalf of the employee directly, right? So the company pays the employee $10, that is the rate, but the employee gets $8. The other $2 goes to the government directly. Are you following? Automatically. So that is called the payroll deduction, right? $2 deducted from the 10, and then you have the net pay, which is 8, right? This is the tax. Who's paying this tax? From whose pocket this tax is coming? The employee, right? The employee. So let's take a look at this entry here, journal entry here. You have salaries and wages, 100,000, right? And you have three different types of taxes here. The FICA tax, the federal income tax, and the state income tax, okay? These three taxes, there are three different types of taxes. FICA is Social Security and Medicare tax. It's 7.65% paid by the employee, okay? Now, don't be worried about the percentages and so forth, right? You don't have to remember all of that, but I'm just trying to show you what tax does to the earnings, right? So this is Social Security tax, 7.65% employee pays. Then you have the federal income tax, which is 21,864, that the federal government takes, right? The federal government, the central government that is running the entire country. Then you have state income tax that the state takes, okay? Now, alhamdulillah, I am a resident of a state that does not tax, right? So Tennessee is one of the 5 states that does not have income tax, okay? So alhamdulillah, I don't have to pay state income tax, but I have to pay these other taxes on my earnings in Qatar, yes, right? But it is less, the rate and the deductions is less than if I were to live inside, but there is tax, right? And it's not pocket change, I mean, it's thousands of dollars. Okay, so here now you have this 7.65%. So you see somebody making $100,000, and this is not exaggeration, this is what the real tax is for someone who's making $100,000. If his annual salary is $100,000, he will only see, or she will only see, $67,564, right? The other goes to the government. So this would be recorded as a payable to all of these cases, and then the cash is going to be given to the employee, and the payable would be offset by the amount that the employee is going to get. Are you following? Yeah. 33%. 33% is gone. Now, if you're married, it's a little bit less. You have children, a little bit less. You have more children, a little bit less. Right? Follow. But, you know, approximately when I was inside, I was living in the US, approximately my tax was 25%, including, you know, taking into consideration that I was married and I had children and so forth. It was 25%, about 25% of what I was making was going into taxes. No. If it was optional, nobody would pay. No. Social Security and Medicare tax is for when you retire and if you don't have enough income, right? And if they have money to pay you at that time, right? So again, this is, who knows, right? I get a statement from the Social Security and this is how much I have paid and so forth. But if you do need, if you are in need, this money will reach wherever you live. Right? So if I live wherever I am in, if I retire and I live here, Social Security tax, if I am eligible to get the Social Security payment, they will send me the money here. Okay, so there's thousands of dollars are sent to people who have retired in other countries and so forth. It's there. So money is still there. The government, the company, if you have a job, if you work as an employee, this is how it is. If you have your own business, you have to send yourself. Right? For example, I send my tax myself, right? Because Qatar University does not send them my tax. I send them every 3 months. I have calculated the tax and I have filed the form. So they draft my bank account. I have an account obviously in the US, so they draft my account for the amount of tax every 3 months, right? Every 3 months they take. And at the end of the year, calculating the actual tax, if it is more, then I will pay additional. If it is less, then I would get back. Right? You follow? They, of course, they change. The tax rules changed tremendously in the last 2 years under the new administration, and I'm thinking it will change again in the upcoming years because of the new administration. So they change, but not significant. But sometimes it could be significant. Last year it was significant for me because they doubled the child tax credit. So the child tax credit was $1,000 before. Last year it was $2,000. So I have 4 children, so 1,000 increase for every child. That means I saved $4,000 in taxes. And the Joe Biden said he would make it 3,000. That means another 4,000 for him. Right? So if he makes each child tax credit 3,000 with 4 children, I will have even one more 1,000 increase for every child. So it make a significant difference, but significant differences don't come often. So we just talked about the taxes that the employee pays. Now we have the taxes that the employer pays on behalf of the employee. First is FICA tax. FICA tax is a Social Security tax. Now, Who remembers the percentage I said the employee pays? 7.65. The employer also pays 7.65. So the total FICA tax collected for the employee is 15.3%. 15.3%, okay? So let's say somebody makes $100,000, $15,300 is deposited into his Social Security account. You follow? Hypothetically, the money is not kept there, but his statement would show that this is how much Social Security was paid. So half of it is paid by the employee, the other half is paid by the employer. So now, not only does the employer have to pay 100,000, now you have 107,000, right? 107,650, because the 7,650 has to be paid on behalf of the employee by the employer. Are you following? The employee pays 7,650. The employer also pays 7,650 on behalf of the employee, right? On top of that, the employer has to pay federal unemployment tax. It's called FUTA, and state unemployment tax is called SUTA, S-U-T-A, F-U-T-A. So what happens to the employer's tax expense? The employer now has a tax expense of 13,850. This is on top of the 100,000 that the employer paid the employee, right? The employer paid the employee 100,000. The employee paid 33,000 of that from his or her pocket to the government, and the employer now pays, in addition to that, 13,850. See the 7.65% for the FICA tax, 0.8% for the state unemployment tax, and 5.4% for the federal unemployment tax. Federal unemployment tax is fixed because it's federal, everybody will pay that. State unemployment tax can vary from state to state, okay? So this...
These are the employer's expenses on each employee.
This is on each $100,000, yes.
In addition to the $100,000 they're paying the employee.
That's right.
Some of that goes to the.
That's right. The employer pays 113,850. The employee gets 67, and the federal government and the state governments get about 43. Okay, are you following? Okay. So this is, all of this is current liability because it has to be paid within a month, maximum 3 months in some cases. Okay. Taxes paid to the government. Salary obviously is paid every month. These taxes, some of them are paid monthly, some of them are paid every quarter, every 3 months. Are you following? Is right. Okay. So taxes, you know. All right. Now, the last item that I'm going to touch on here is bonds. Bonds are another form of long-term note payable, right? That companies issue. This is a type of investment that you can make, buying bonds, and the company would pay you back the amount when it matures. Have you studied bonds in more detail in finance? Are you studying? Have you studied, or is it on the agenda? You already calculated how it's done and so forth, right? Okay, so you have the bonds, you know the details somewhat. They are long-term liabilities because usually they have more than 1 year maturity, right? And then you have face value, premium, discounts, all of those things you have studied in finance, yes? Okay, so this is all the things that I'm going to address in chapter 10, right? And we'll move on to chapter 11. So we discussed the current liability, current assets, we discussed the long-term assets, we discussed the intangible assets, and we're coming to the current liabilities, long-term liabilities, and we have the stockholders equity, which is the last part of the balance sheet. Okay, stockholders equity. Now this, as an MBA, you will be involved with this type of activities more so than issuing bonds and notes and so forth, okay? You'll be involved more so with this type of activities because no matter which company you work for, it is going to fall in one of these categories. So you can classify an entity or an organization as not-for-profit, or you can categorize it as for-profit, right? So for example, Qatar University is not-for-profit, right? Qatar Charity, not-for-profit, right? On the other hand, if you look at Lulu, for example, it's a for-profit entity, right? Carrefour, right? It is a for-profit entity. So here we have some examples from the US: Salvation Army and Cancer Society, and for-profit, Facebook, IBM, Caterpillar, General Electric. So this is one categorization. And then the for-profit entities can be classified into two categories. One is publicly held and the other is privately held. Publicly held are those companies whose stocks are sold in the stock market. So we have about 40 companies in Qatar that are publicly traded, right? Ooredoo, Vodafone, Qatar Petroleum. There's, you know, you have gone to the website, you have downloaded the financial statements, so you know those are publicly traded. And the privately held companies are closely held businesses that are owned by a small group of people. You cannot buy their stock in the stock market. So they're privately held companies. Most businesses are privately held. Okay? Most businesses are privately held. Okay. Now, the formation of an entity to do a business, right? Having a separate legal existence gives you certain benefits. So you have a corporation that is independent of the people who own that corporation. So it has a separate legal existence. You can file a court case against the corporation, right? Against the corporation. It is a legal entity. It exists by itself. It limits the liability of the stockholders. So let's say you have a corporation and you have purchased some stocks in that corporation. You have paid 10,000 riyals and you purchased the stocks. And somebody has a court case against the corporation and the case is lost. And the corporation has to sell its assets and pay the person who sued or the claimant. They cannot come to your individual assets. You have a home, you have a car, you have other things outside the company. Your liability is limited only to the 10,000 that you invested in the corporation, right? On the other hand, if you don't have a corporation and you are by yourself doing business, it's your name without forming a corporation, then everything you own, right, is open for grabs. You follow? It can go. All of this can go if somebody sues because the company and you are one and the same. A corporation has a separate legal existence. You following? So it limited liabilities of the stockholders only up to the amount they have invested, nothing more. Also, the ownership is easy to transfer. So you have 5 people coming together buying stocks, forming a corporation, buying stocks. If you want to leave, you can sell your stocks to somebody else and you can exit and somebody else can become the owner. Very easy to transfer the ownership, right? If the company is big enough, it is easier to acquire capital. So again, if you sell stocks in the public stock market, if you sell the stocks in the stock market, obviously you can acquire capital, you can sell more stocks and get more money. If your company is big enough, it has business and so forth, you can also borrow money from the bank in the company's name if the company has a reputation, right? the company has performed well in the past, they have financial statements that shows the performance, you can borrow money in the name of the company. It has a continuous life, so some shareholders may pass away and the company would continue, right? Their stocks would be inherited by their children and so forth. The company will exist, right? The corporation will exist longer than the life of the shareholder. And because you have a big pool of people, you have a better group of people to choose your management from. You can have a better group of people instead of just you. You can have a pool of talents from which you can bring people to manage the company. All right. So these are some benefits of the corporation on the surface. And then if you are ever involved in forming a corporation or dissolving a corporation, you know there are much more details than this, but these are some surface advantages of it. The disadvantage is corporation management. So it's listed as an advantage and this is a disadvantage. Why is it listed as a disadvantage? Because it requires a lot of resources, right? It requires a lot of resources. So you have to pay people to manage the company affairs because there are a lot of administrative affairs that you would not have if the corporation was not there. Okay? Agency, yes. What do you know about the agency problem? Conflict of interest between right. So the agency problem is absentee ownership, right? People who own the company are different than the people who are running the company, and people who are running the company are supposed to have the best interest of the people who own the company, but that's not always the case, right? Well, that is almost never the case. Anyhow, so that's the agency problem is something that a large group of researchers in accounting and finance spend their lives trying to understand. Right? I looked at, there are 9 A-star journals in accounting that are ranked highest. I looked at, in 2018, I looked at the latest issue of all of those journals and looked at the articles. There were 90 articles, and I think %57% or something like that, I forgot exactly, of the articles are dealing with the agency problem, right? Agency issue, agency problem, okay? Anyhow, the agency problem is not the primary problem here. The corporation management is much more than that. Even if you don't have the agency problem, managing the corporation affairs could become cumbersome as you're growing, right? You also have government regulations to deal with. There are extra taxes and regulations that different governments pose on different types of corporations, and you have to be aware of them, you have to handle them, and they change when the government changes. And you have additional taxes, obviously. The corporation is taxed on its income. So there is double taxation. So the company pays the salary to the employees, they pay the tax, and the company also has to pay taxes when it earns the income. And then when it pays the dividend from that leftover income, the shareholders again have to pay tax on that dividend, right? So taxes above taxes, right? So a typical corporation is organized in the following way. The shareholders, as you see, are on top because they are the ones who own the corporation. The shareholders have voting rights. Every share has one vote. So if you own 10 shares, you would have 10 votes, right? If you own 51% of the shares, that means you can manipulate the way the company is run. Okay, if you own 51% of the shares, then you have majority of the vote. The shareholders elect the board of directors. So the board of directors are representatives of the shareholders. Board of directors are also shareholders in the company, right? So the shareholders nominate and then they vote, right? The board, the directors of the board. The directors of the board then select a chairman of the board. So let's say you have 10 board members. They decide who's going to be, by vote or however they do, decide a chairman of the board. So there is a chairman of the board, and then you have the board. The board appoints the president and the chief executive officer of the company. So the chief executive officer is accountable to the board. The board is accountable to the shareholders. You follow? And the board can be changed. Usually there is a general meeting every year. You can vote and remove an existing board member, and you can put somebody else in the board, right? Say that again. Yes, of course. The board, the directors of the board are also owners of the company. You follow? So they are elected by the shareholders. Okay?
There's like a lot of policies in place in terms of like conflict of interest. The board of directors can know the performance of the company before the announcement of financial statements. But there has to be like waivers signed by board members to say that they're not going to make.
Right. So if we get into that, I mean, the regulations are so many, right? And it varies from country to country, and it varies from state to state, even within the same country, right? So again, that's another, can of worms we don't want to open here. So we have the chief executive officer who's selected by the board, and then he is or she is the chief executive officer to whom everybody in the company reports. So you have a general counsel or general secretary, you have the president of marketing, you have the vice president of finance, you have the vice president of operations, you have the vice president of human resources. And again, these positions are depending on whichever the company needs. There may be a vice president of quality control, there may be a vice president of production, depending on what the company needs, right? So every single unit has a vice president. And under the finance VP, you have treasurer, who's in charge of the funds of the company, right? So all the funds are under the treasurer's control. The treasurer signs the ultimate disbursement authorization, and the controller is the head accounting officer. The head accounting officer is called controller. Okay, the head accounting officer is called controller, who reports to the VP finance, right? So you have VP finance, you have treasurer and controller. So far so good? So this is the general structure of an organization, of a corporation. Outside of corporation, other than corporations, you have other forms of entities such as limited partnerships, right? Limited liability partnerships, limited liability companies. These companies have different rules for having partners and having general partners. I don't think we want to get into every single one of these entities, but these are other forms of entities where the entity has a legal existence, right? So you have limited partnerships. Why is this limited? Because the partners are limited only to what they have invested, unless there is a general partner. A general partner, who is usually the managing partner, cannot have limited liability. Maybe his or her personal assets are also subject to the court case if there is a problem, okay? There is a particular type of corporation which is called S corporation, and this is a popular type of entity. The two most popular type of entities for small businesses in the US are limited liability companies and S corporations. Limited liability companies and S corporations. And we have something in Qatar that's called WLL. You have seen this written WLL, that is LL is limited liability. That's a form of entity as well, right? So all these type of entities, they have limited liability of the owners, right? Whatever they invested, that is subject to loss, or if there is a court case, the claimant can claim that. The personal assets are protected. In the case of an S corporation is different from a regular corporation in that the corporation itself does not have to pay any tax. Okay? The earnings are distributed to the shareholders or the stockholders, and they pay tax on that. Okay? So the corporation is not subject to tax. So there is no double taxation if there is an S corporation, but the limit on the number of shareholders is 100. So the S corporation cannot have more than 100 shareholders. And for the purposes of counting, husband and wife are considered as one shareholder. So you can have 100 married couples own an S corporation. This was when I was practicing 13 years ago. This was 75. The number was 75. 75 was the maximum number, but it has increased. Obviously, it's now 100. You can have 100 shareholders, or 100 married couples, if you will, as shareholders. Okay, so these are some other forms of entity. Company and S corporation for small businesses. Remember, if you have a big business where you need to have more than 100 shareholders, you obviously cannot, right? Or if you have to go public, S corporations cannot go public, right? Because by default, if you go public, you have to have more than 100 shareholders. All right? Yeah.
You mentioned about the general partner. The general partner, if he has a major goal, so does he come under limited liability?
No, all of these limited liability companies, the limited partnership, limited liability partnership, limited liability company, LLC, all of them have a general partner whose liability is not limited, right? He is usually the managing partner, right? Now, you can have a limited liability company. It is possible where nobody is a general partner. It is possible in the case where the investment is passive. For example, if you have rental real estate, you have residential rental real estate, there is nothing to do per se. You just collect the rent at the end of the month and somebody goes and repairs if there is any maintenance request. But there is no active participation, follow, by the partners. It's a passive business, right? You could be working at a job, that's your active earned income, and you could own. So 4 people could come together and they could buy a building, for example, a building that has many flats, and they rent it out, right? So all of them could be limited liability. If somebody actively manages the business, then they're usually no longer limited liability. Does it follow?
Oh.
Just one more thing, you mentioned about the 100 shareholders. This applies just for S corporations?
It's S corporations.
Or for all?
No, not for all. Not for all. The 100 is only this. These two things are only for S corporations. Okay. No double taxation is also applicable to all of these. No double taxation is applicable to all of these entities. The 100 shareholders is limited only for the S corporation. LLCs can have more than 100. But usually it is not even more than 10. You follow? Because they are closely held companies. I mentioned to you that stockholders have the right to vote, right? So each stock has a vote in the election of the board of directors. They also have the right to share in the earnings through dividends. So if the shareholders own the company, they also have, if the dividends are given, if dividends are distributed, then every shareholder has the right to the dividend, right? They also have something called preemptive right, which is keep the same percentage ownership when new shares of stock are issued. So let's say the company issued 100,000 shares, right? 100,000 shares, and you have 10,000 shares. That means you have 10% ownership, okay? If the company issues additional shares, right, you have the right to keep, you have the right to buy and keep your percentage 10%. You will be given the option to do that. Follow. So you can buy up to that percentage. In addition, yes. Huh? No. So of the 10,000 that is issued, you can buy 1,000 to keep your percentage 10%. So you have 10% of the 100,000. Of the 10,000, you can buy another 1,000 to keep your percentage of ownership 10% in the 110,000. Right? You have the priority. It's preemptive. It's called preemptive right. It's your right to keep your percentage. If the company is dissolved, if the company is liquidated, right, then the first claimants are the lenders. So if you have loans, then those people will be paid first, and then the shareholders. So if the company assets are sold, first the loans will be paid, and if there is anything left, it will be distributed based on the ownership of the shareholders, right? These are, theoretical rights and so forth. If the company is bankrupt and so forth, you may not see anything of that, right? All right, so far so good. Now, the rest of the discussion, whatever we're going to discuss from now on going forward, it is related to the stock, okay? It's related to the stock. So let's look at this a little bit. We have something called authorized stock. Every company has a number of authorized stock that is given to the company when it's formed, and it can issue up to that number, okay? So that is the maximum number of stocks that they can issue. That is called the authorized number of stocks. This is usually reported in stockholders equity section, how many stocks are authorized and how many has been issued, okay? No, this is unless there is a change, unless you file a change and it is approved. This is when you form the company is authorized to issue. It's a huge number, right? It's a huge number. Huh? This is a good question. I'm not 100% sure about the mechanism of this. It depends on, how large you are, what type of influence you have, how much you can negotiate and so forth. I'm not 100% sure exactly who decides that, right? This is done by the lawyers. So the lawyers and the owners of the company, they are involved, right? We start with the number that is authorized. So sitting, let's say, in a company, I'm the controller.
I'm told this is what we are authorized. We follow. So I know that we cannot issue anything more than that. You following? The company issue common stock through directly selling it to the investors, or it can hire an investment banking firm that would sell its stocks. Right? You could hire investment banking firms like Charles Schwab or Goldman Sachs. Right? They would sell your stocks. They will do the brokering of your stocks. And again, what is the mechanism of this? I don't know. Right? This is done by the lawyers and the owners of the company. Okay. Now, the stock is given a par value. What does that mean? A par value is an amount that is decided at the beginning that the stock price is going to be X dollars in par value, and usually it is very small. It may be $1 par value. Like $1 par value means that the stock is initially given a value of $1, and the sales price is always much more than that, right? The par value is important for accounting because when you record common stock, it is recorded at par value, and anything extra received above the par value, it is called additional paid in capital in excess of par value. It is written there, it will come, it will many times, you don't have to remember it like that. So before, the par value was something that the company had to maintain in capital. They had to have the capital equal to the par value, but it's no longer the case. Many states do not even require the par value. So that you may have stocks that are with no par value. And some states in the US have something called a stated value. Stated value is similar to a par value. When there is no par value, the board of directors can give a stated value. And what is the role of par value and stated value? You will know in just 2-3 minutes. I'm going to explain to you what is the circus about the par value. Why do we do this? What happens? You have two primary sources of equity. One is the paid-in capital, which is from the sale of stock, right? Which is from the sale of stock. Now, you have two different types of stock, as you see here, common stock and preferred stock. We're going to talk about the preferred stock in a little while. Common stock is the stock that is issued, the stock that we have been talking about. Each stock has a one voting right, right? That's the common stock. You get dividends, you have rights to the dividends, you have rights to the assets if it's dissolved, etc., etc. The common stock account only records the amount of par value. So if you have a stock that is sold for $10 and the par value is $1, that $1 is going to be recorded in the common stock account, and the $9 in excess of the par value is going to be recorded as paid-in capital in excess of par value. Okay, so you will get cash debit $10, common stock credit $1, that's par value, and paid-in capital credit $9, that is in excess of par value. Same is true for preferred stock. Preferred stock is a different type of stock. I'm going to explain to you what it means. But the recording of it is the same. Preferred stock, paid-in capital in excess. Yeah, I'm going to show it to you. I'm going to show you the entries, inshallah. Just mentioned to you, it will come. We'll have several examples. This is one way of getting money. So the company gets money by selling stocks. The company could also, as you know, get money by selling goods and services. And money that is reported in the income statement ultimately comes to the retained earnings. We have all recorded this in the balance sheet. The bottom line of the income statement gets added to the retained earnings, right? You know this, you've done this. So the paid-in capital is the amount that is in excess of the par value, okay? So this is the paid-in capital, and the retained earnings is the net income. You already know. Okay? We discussed this, and you have recorded many entries. For example, this, right? Now, $1 million question is, what type of entry is this? Debit to income summary, credit to retained earnings. If you were to classify that, what type of entry do we call this? Closing entry. Very good, very good. Closing entry, right? Which is step number? Huh? How many steps are there total? 9. What is the last step?
No, it's the final one. Addition something.
I'm going to reduce your score from the first exam. The last thing that we prepare in the financial statements, the accounting cycle, it starts with post. Post office. Yes? What is it? Post closing trial balance. That was like pulling a teeth. Post closing trial balance. Right before post closing trial balance is closing entries. Which one of these? So you close all the income accounts to income summary, close all the expenses to income summary, and you close the income summary to. I made you say this a few times, right? Maybe I need to do it more. Income summary is close to the retained earnings. This is the last entry, right? This is the last entry. So all income and expenses goes into the retained earnings. So that is the $130,000 income. So net income is recorded in retained earnings by closing entry. By closing entry that debits income summary and credits retained earnings, assuming that net income for the year is 100,000, 130,000. So there is no mystery here. You know where this comes from. You know all the steps, right? My mistake was to give you a break in the actual exam and not go all the way to the post-closing trial balance. I stopped at step 5. That is my mistake. That's why you don't remember, right? because I did not give you the 9 steps to do in the which probably have been here until sunrise. Anyhow. Okay, so one more slide and take a break. So you see here, the company has 800,000 in common stock, which is recorded here in the equity section, and you have the retained earnings. You know where these two numbers come from. The common stock comes from selling of the stocks, and the retained earning comes from the operations of the business, right? So this is a good place to take a break, inshallah. So let's take 10 minutes, and inshallah, if you come back, we may be able to finish within another 30 minutes or so, and you can go. Okay, so take a break quickly and come back.